Hi everyone, I am Dr. Naglakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNS Rajalakshmi College of Arts and Science, Coimbatore. I am here to explain a concept in the course Cost and Management Systems in the topic Ratio Analysis. We are going to see the introduction to ratio analysis. First, we should know what is meant by ratio analysis. See, ratio analysis is nothing but it's an important tool which is used by the management in making the decision making. Now we are going to see what is meant by ratio analysis. Ratio analysis is the quantitative analysis of information contained in a company's financial statement. So, ratio analysis is the quantitative analysis of information. So, the analysis. So, quantitative information means what is quantitative information? The quantitative information means what is the actual financial position of the company. So, what is the profitability position? What is the sales? What is the production? What is the demand? So, these informations will be interpreted in order to get a result. Ratios are used to evaluate various aspects of a company's operations and financial performance. That is, this tool is used in order to evaluate means in order to know what is the actual company's operating and financial performance. So management has to take decisions. So management should know what is the position of the company. For that purpose, they use a tool called as ratio analysis. Now we can see the purpose. So purpose of using ratio analysis to assess the liquidity, profitability, efficiency and solvency. These are very must for a management to know about the company. So what is the liquidity position, what is the profitability position, what is the efficiency position and what is the solvency position of the business. So next purpose is to assist in decision making by shareholders. So by the stakeholders. So to assist in decision making by the stakeholders, who are all the stakeholders here? The customers are the stakeholders, the investors are the stakeholders, the shareholders are the stakeholders, the debenture holders are the stakeholders, the banker who lent that is given the loan, the creditors, everyone are the shareholders. They have to take the decision whether to continue with this company or not. What is the actual position, whether the position is positive or negative. The next purpose is for trend analysis and inter-firm comparison. Trend analysis. Trend. What is the previous year trend about the production? What is the that is year before, previous year? What is the position of the production? So what is the sales? So they will be considering the year-wise performance, and inter-finance firm comparison will also be made. Inter-finance means inter-firm comparison means here that is for example, I am a manufacturer of a toothpaste. That is, I am a Colgate. So I have to make the comparison with my competitor, that is with the Pepsodent or with the Close-Up, in order to know what is their production, what is their demand, what is their sales, what is their profit, what is their price, what is their cost incurred for making the production. So these things will be compared by the other competitor with our company in order to take the decision whether it is to be continued or it has to be discontinued. Next is the objectives of ratio analysis. Performance evaluation, trend analysis, interfirm comparison, investment decision, creditworthiness evaluation, managerial decision making. So these are the objectives of ratio analysis. So performance evaluation means understanding the profitability, efficiency and solvency of the organization. Trend analysis means tracking the performance over time for past 5 years, for past 7 years or past 3 years, like that. Interfirm comparison is compare with the industry peers. So in for example, if it is a cement industry, ACC cement factory is to be compared with Dalmia cements or Ramco cements to know what is their position, profitability position, solvency position, efficiency position, production, demand, sales, everything. Investment decision. So helps investor assess risk and return. Risk and return means, so investors are making the investment in order to get the return. So they should know whether their decision in investing in our organization or our company is good or not. Whether they have to take back or to make more investments. Creditworthiness evaluation help lender assess a firm's ability to repay loans. If you are going for expansion of a business or to make an introduction of a new product, so we need of a lender for investment. So if we go for lending, they will assess whether we are in the position to repay the amount if they lend to us. Next is managerial decision making. Provide insights into operational strengths and weakness. So managerial decision making is in the hands of the management, top management. So with the ratio analysis, they will get the knowledge about the operational strengths and weakness of their company. Now we are going to see the types of ratio analysis. So ratio analysis is typically divided into 5 main categories. So first one is the liquid ratio, second one is the solvency or leverage ratio, third one is the profitability ratio, fourth one is the activity, that is efficiency ratios, and the last one is the market ratio. Now we can see. So what is the purpose of using liquidity ratio? In order to know ability to meet the short term obligations, whether the company is in the position to meet the short term obligations, that is what is the current ratio position, what is the quick ratio position, what is the cash ratio position. Likewise, solvency or leverage ratio, it is used in order to find out the long term financial stability. So what is the debt equity ratio, what is the equity interest coverage ratio, what is debt ratio. So these are very important for whom? For the lenders, for the stakeholders to know about the organization. Profitability ratio. So profitability is an ultimate aim of an organization. So an organization is started in order to earn a profit. So efficiency in generating a profit is ascertained with the help of profitability ratio. So net profit margin ratio, gross profit margin ratio, return on asset ratio, return on equity ratio is calculated under profitability ratios. Next, activity or efficiency ratio is used to know the asset position. So inventory turnover ratio, receivables turnover ratio, asset turnover ratio, these things can be ascertained with the help of this activity ratios. And the last one is the market ratio. Market ratio means earnings per share. So the person who has invested in the business as that is in the form of share, so what will be the dividend he receive out of his investment? So earnings per ratio, price to earnings ratio, dividend ratio, dividend yield ratio. So these three things are ascertained under the help of the market ratio. So investors related indicators, that is this ratio is said to be the investor related indicator. Next is the interpretation of the ratio. So high or low, a high ratio isn't always good and vice versa. For example, a high current ratio may suggest poor asset utilization. Likewise, industry benching, that is comparing the industry averages to contextualize ratios. Next is trend ratio. Look at the direction over multiple periods to gauge improvement or decline. Interdependence ratios must be read in combination, not isolation. So this is what about the interpretation of ratios. So interpretation means the result what we got out of the calculation of the above ratios. Okay. Next is the advantages. So advantages means simplify. What are the advantages? Simplifies financial statement for easier understanding. So it is the stakeholder may have a knowledge of economics or accountancy or nothing. We cannot say they may have that idea. So with the help of these ratios, anyone can understand the financial statement of the company. Facilitates comparison between companies and across time, helps in decision making for managers, investors and creditors, then identifies trends in financial performance, assess operational efficiency and financial soundness. So these are all the advantages of ratio analysis. Next is the limitations of ratio analysis. What are the limitations? So everything will have its own advantages and its own limitations. Now we are going to see what are all the limitations of ratio analysis. Historical data. So the data is said to be historical data. Historical means which is already recorded. That means sometimes for accounting purpose original values will not be recorded. Original values will not be recorded for accounting purpose. In such case, so the result, that is we will be applying the ratios in order to find out the result. That result may not be a right one. That is, ratios are based on past data and may not reflect future conditions. Like then different accounting policies. Comparison may be misleading due to varying accounting treatments. Next is inflation effect. So ratio may not adjust for inflation. So here what is the actual position of the country? What is the inflation rate? What is the GDP rate? So how the economical position of the country going? So these things will not be accountable for the ratio analysis. They won't consider these things. Window dressing. Financial statement may be manipulated to improve data. That is, improve ratios. Yes. So the company has to showcase that they are in a good position, because they have to survey in the market. Their market share should not go down. They will not be in a position to reveal that they are in a losing position. They have to maintain their market. So financial statement may be manipulated to improve ratios. No qualitative analysis. Ratio don't capture non-financial factors like employees' morale or customer satisfaction. So ratio is calculated only based on the data available in the financial statement. So it does not consider the non-financial factors like employee morale or customer satisfaction. So these are the limitations of ratio analysis. The next heading is use in decision making. So where it is used? Management. So management will use this ratio analysis to streamline operations and manage debts. Likewise, investors to judge the profitability and investment potential. Next, creditors to determine financial stability and loan repayment ability. The next one is the regulators and analysts. So to assess compliance and risk. So these, that is, the ratio analysis is used only for the decision making, and this will be handled by the top management and by the stakeholders. Now there is some example of quick ratio interpretation. See, quick ratio is equal to current assets minus inventory divided by current liabilities. If a company has a current assets of 2 lakhs rupees, inventory of 50,000 rupees and current liabilities of 1 lakh, then what will be the quick ratio? We can apply the formula. Current assets 2 lakhs minus inventory 50,000 divided by current liabilities 1 lakh. So we will get 1.5. 1.5, that is interpretation. We can see the interpretation. For 1 rupee of short term liabilities, the firm has 1 rupee 50,000 of quick assets. That is, if a company wants to repay anything of short term liabilities, the company is able to pay off. A ratio is the ratio above 1 is usually favorable, suggesting good short-term financial health. Thank you. Thank you so much for the patience listening. I think you might have understood what is meant by ratio analysis. Thank you. Thank you so much.